Welcome, everyone, to CRE Fast 5 Secret Sauce, the show where we hear real-time insights from commercial real estate industry leaders. I'm Karly Iacono. Today, I am excited to be joined by Dennis Cisterna from Sentinel Net Lease. Dennis, welcome. How are you today?
Thanks for having me, Karly. Really appreciate it.
My pleasure. So glad you could join us. I want to jump right in and hear about your role as CIO of Sentinel Net Lease and kind of what the company's all about. So kick us off.
Yeah, absolutely. So, I'm actually a co-founder of the company with my partner, Fred Lewis, who serves as our CEO. We started the company right before COVID hit, not, of course, knowing COVID was going to hit. But really, we started it because we saw some unique opportunities in the middle market in the net lease sector. And so we thought there were some arbitrage opportunities, maybe an ability to buy a couple assets at the right price. And then COVID hit, and we saw more opportunities in those months when a lot of people were panicking, and luckily we weren't. And we built a platform around that idea of trying to buy stabilized net lease assets at cap rates that were outside of the normal market norms, where we thought maybe the assets were mispriced. There's just some inherent value that maybe the brokers or the sellers kind of missed. And so we've grown the platform from there. We've acquired over $320 million of properties since 2020. We are entirely financed by private investors. So we don't have any institutional capital intentionally. And our focal point is really on value and basis and looking for those outsized returns and those needle in the haystack opportunities. And because of that, we're one of the few guys that are consistently buying office right now, which is a lot of fun, and not too many competitors in that space compared to some of the other sectors.
So much we need to unpack there. I am sure it has been a wild ride launching your own company right before COVID, and then getting through all these market, waves that we've had since, and then having office be your focus on top of that. So we've got a lot to talk about.
Yes.
Let's start with office, because I know everyone wants to know. We're going to start with the juicy stuff first. How are you focusing on office? What is the angle, the value proposition? How are you mitigating risk? Let's just jump into why you are focusing on the lease, in-demand asset type right now.
Yeah, that's a great question. And it's because of that general sentiment, right? It's the macro headline that office is bad. And while yes, office has struggled in a post-COVID environment where return to work has not been as fast as a lot of folks want, that doesn't mean all office is bad. It doesn't mean all office has zero utility. And so I think a lot of the conventional wisdom, in this headline stress disorder that people get comes from what's happening in Manhattan and San Francisco and LA and downtown Chicago. And when you look at a handful of markets, you realize that's actually like half of the problem in the entire country. So, while some people are zigging away from office, we're zagging toward it, and we are being very selective in what we're acquiring. By no means do I think people should just be long office as a macro bet. But I think if you are disciplined and data driven, you're going to see a lot of opportunities out there to buy things at historically attractive basis, really high cap rates that have really long-term lease duration in there, especially in the single tenant sector. And so that's what we like about it. We are long-term believers that the ultimate productivity of employees is in the office, not at home. Obviously, that doesn't go for every type of employee, but there was a recent survey of over 1,000 companies, and 92% of the executives responded, we would like to have our employees back in the office more. That is our plan over the next 12 months. And now that the labor market is cooling a little bit, we're going to have the leverage we need to start pushing people back in the office to increase that productivity we need to sustain whatever type of recession is coming, even if it's a soft landing.
So you believe in office long term because we are more productive working together in an office environment. I don't disagree with that. You specifically mentioned long term leases. Are you buying exclusively single tenant net lease office product? Or are you buying multi tenant? I have seen less long term leases in the multi tenant space, but I'm wondering if you're bridging both of those, or are you exclusively in single tenant?
Not exclusively single tenant, but because obviously when you're dealing with a multitude of tenants, it's hard to get a weighted average lease term that's going to be long enough, because most landlords are trying to stagger those leases so they don't have some substantial blowout of their rent roll at any given year. On the multifamily side, we're really looking for stuff that's kind of up to maybe 10 or 12 tenants, nothing more than that, and usually with an investment grade anchor. But yeah, Singleton is definitely the primary focus, mission critical real estate, a lot of headquarters, things like that we see. People are in the office, if not every day, almost every day. And they've got their employee counts back up, and there's real value there. I don't want to go into a dark building. I don't care if it's a 15 cap, a building on a Wednesday that has 6 people in it, right? The writing is on the wall there eventually. But you'd be surprised, especially if you go outside of some of those large coastal markets, just how hopping some of these suburban markets are. And that's the other part of our strategies. We don't do anything in the central business districts. It's only suburban markets as well.
So you've really found a way to mitigate risk in the office market by looking for long WALTs, by looking for an investment grade credit tenant, or at least an anchor. And I think those two things alone must give your investor base a lot more security, while, like you said, still allowing you to get outsized returns because of just the sentiment overall in the segment. So
Yeah.
kudos. I think that makes all the sense in the world. How are you looking at geographical diversification? You mentioned that the coastal markets had been hit harder. Are you avoiding those, or are you just being more careful to look at suburban pockets? Like, how are you approaching market diversification?
Yeah, so I think that is a huge part of any company's investment strategy, to not be overweight in any one uh, area, even one asset class. Obviously we focus on office, but we also buy industrial and retail too. We like to have that diversification, not only of area but of asset type as well. I think where we see the most value is the areas that most of the larger institutionals will glaze over, or fly over, if you will, as a common term for a lot of the Midwestern markets that we like. So if you look at the demographics of these areas, they're growing populations. They may not be growing as fast as the fastest big areas in the country. Although we do invest in Florida and Texas, but you can find a great story in Nebraska and Missouri and Oklahoma and Indiana and a lot of other areas. If you're really getting down into the weeds on what's driving that local market, and I don't think you have to be from that market to understand what drives that market. But we are data driven, so it's a big focal point for us to understand, why is that market growing? Does it have industry diversification? Is it reliant on just one big employer? And those things help tell a story about why the real estate we're acquiring is important, not only to the company that is the tenant, but also to the local area, the municipality. It's a lot that you can never do just from the desktop in New York or LA, which a lot is the way a lot of the hedge fund guys are wired. So we get it on a plane constantly, and we meet with the mayors and the economic development directors, and even if we haven't spent a substantial amount of time in that market, by the time we leave, we feel very comfortable with understanding why this asset has value here.
I was just going to say, I bet you are on a plane every other day, because there's no other way you could get that sort of granular market data except being there throughout time. And how long does that sort of a local evaluation process typically take you? I mean, that's a tough thing to really get your arms around. You just mentioned you've got all the data, of course, that we all do, that you can see from your desktop, but you also need to physically be there to evaluate it. How long does that whole process take you typically?
Yeah, so I mean, it depends on, we're not going into a particular market before there's an asset to review. So I'm not just going to
Right.
drop into a market and spend a week there for no reason in particular, because who knows if an asset ever shows up there, right? So,
Of course.
but we really have a 3-step process to analyze properties. And the first is that desktop review, kind of our pre-underwriting. That's very data driven, making sure we understand population trends, income trends, quality of life. Like, is this a place people actually want to live? And if they want to live there, chances are they're going to work there. So that's step one. If we've got a property under contract or close under contract, I am flying out personally. Sometimes my partner Fred will join me, and we will set up meetings a week in advance, 2 weeks in advance with those stakeholders I talked about. And we'll spend in between 3 and 5 days in a market, and we'll probably have anywhere from a dozen to 2 dozen meetings with people just so we can understand, the special sauce of that market. Make sure we understand the local players in that market, any trades that maybe we weren't able to access via our data systems. And that just is so important to unlock that information. And yes, it's hard work, and yes, it's not cheap, but it's so worth it. When you're talking about investing tens of millions of dollars into a single property, you owe it to yourself, you owe it to your investors to do that level of diligence. And I think that's becoming more and more rare, because you see these funds that are increasing in size, multi-billion-dollar allocations, and these guys want to go put the money to work quickly. And I'm buying some of those properties now as folks shift their allocation. And as I look through their diligence, I am appalled by how paltry it is.
So you do your homework, you spend the time in the market, and that allows you to make safer and hopefully more profitable long-term investments. Seems
Yeah.
basic, but you're right. A lot of people have gotten away from doing thorough diligence. So sometimes you've got to go back to basics to get ahead. Ironic,
Well, and
right?
I think with the advent of technology and these advanced data systems, you can do a lot of that groundwork early, which
Right.
is super helpful and allows you to kind of work on multiple deals at once. But I started my career as a housing market analyst. I used to drop into markets all over the country, and I would have 3 or 4 days to understand it, and then write a feasibility study on a place I'd never been to, on a development plan. So luckily that initial training, when I was still in college when I started, has proved to be instrumental, and something that I still adhere to this day.
Love it. Let's switch gears for a minute and talk about net lease retail. What do you like in the sector right now, and where do you see opportunity?
I like a lot in the retail sector. I think we're seeing
Good.
I think we're seeing a significant shift where everybody thought brick and mortar was going to be dead, which is why retail got beat up before COVID or anything else. And then the lights have come on that now retail is really this multimodal opportunity, where it becomes a de facto distribution center, where your clients or your customers can obviously come in and shop normally. They can order online. You can ship directly out of the store. There's just that extra layer of utility that people are starting to unlock as we've seen how consumer behaviors have changed. And I think that's added a ton of value to a lot of important retailers. Our main focal point in the retail sector has been grocery. So we own a handful of grocery stores. We own a BJ's wholesale club. And it's been phenomenal to see how those companies have adapted to embracing technology, not only to increase sales, but really to increase operational efficiency as well. And so I am chasing that constantly, but it's a very competitive marketplace. And because I have pretty lofty return standards, I miss more often than not for those opportunities. There's a number of other big box retailers that are very interesting right now. A lot of them going up, a lot of them going down. And I think that goes back to understanding the credit risk of the tenant. So there's a lot of conflicting narratives out there about what makes a good retailer. And I think the thing that we're seeing with a lot of companies in a lot of sectors right now is those ones that are hyper growth oriented tend to spread their wings a little too fast and get into markets maybe they shouldn't be in. And they're doing that at pricing that doesn't necessarily make sense in that market because they're just extrapolating off their base model. And I think that's problematic. On the other hand, I think you have very tech forward retailers that are very data driven on their expansion plans and looking at how do they reduce their footprint size and still be as efficient from a sales perspective as they were previously. So I think a lot of that is super interesting. I pay a ton of attention to it, and ultimately, I think for those people that are afraid of retail or the death of retail, I think the last 18 to 24 months has calmed a lot of those fears, which I think is great.
It's become the new darling asset type. And you got to get
Yeah.
up to speed here. We're well past the death of retail. But no, in all seriousness, of course, there's a heightened focus on grocery. And I've also seen a lot more attention on big box in our business. And I think part of that, and tell me if you're looking at it this way too, is a lot of the rents are very low. So we have investors who are looking, like you just mentioned, for the credit tenants and the long-term leases, and they're looking for low rollover risk. And then we have a whole nother subset of clients that are hoping for rollover. They're hoping to re-tenant that in the next 5 years, maybe even shorter, because the rents are so below market based on how long the tenant's been there. So big box is definitely interesting.
That mark-to-market adjustment is very real in a lot of places.
Mm-hmm.
And I completely agree with you. There is a total subset of investors that will go in and buy something at a below market cap rate because they know that lift is inherently already there without them necessarily having to do a big facelift to the property.
Right.
Now it makes it tough for me as a stabilized investor, obviously, because what I see more and more often, and God bless the landlords whoever drafted these things, but seeing like a 10-year lease with 40 years of extensions and the rents are basically flat.
Right.
I mean, that's kind of those are built for 1031 investors, I think, not for folks like me. But it's frustrating when you like an asset type and you can kind of see where the retailer or the tenant got the better of the landlord in the lease structure.
That's a really interesting point. So it sounds like you would prefer no tenant options or very few so that you can renegotiate and rework that property. Whereas you're right, a lot of our 1031 buyers and more private clients who are less plugged into the space want just the opposite. They want the longest options possible with structured rent increases, so everything's set and they don't have to think about it or renegotiate anything. So it's two sides of the same coin there on the lease structure. And I think it also depends on, go ahead.
Sorry, go ahead.
It also depends on the balance of power between tenants and landlords at the time the lease was written, right? Because that pendulum swings back and forth, and boy, does it lead to some very different lease forms based on what vintage lease you're looking at, even if you're talking about the same tenant on a national basis.
Yeah, and I think you've got so many different factors that help kind of create that situation. Not only could it be market dynamics, maybe when the lease was signed, it was more of a tenant's market. It could also be a lack of sophistication on the landlord's part when they're negotiating that lease, because to your point, a lot of folks look at security more than thinking what the long-term value of the asset could be. And yes, they're going to secure that income stream for a long period of time, but if you look at the opportunity cost by doing that in terms of the terminal value of the property, it's kind of crazy. It's as Munger likes to say, being a little penny wise and pound foolish.
All different investment theses out there, which is what makes, of course, our industry so interesting. Lots of different strategies. But yes, I agree. I see where you're coming from on that. How do you source your deals? What does that look like? Do you have a team calling owners directly? Do you work with brokers? All the above? Do you build relationships with people in towns that you think you might like to invest in, down the line? What's your strategy?
Well, I will tell you, this is unscripted, but I work with CBRE more than any other brokerage firm.
We did not,
They're
yep,
great.
did not tell you to say that, but thank you. Good to hear.
But of
Gold
course,
star.
I work with a lot of the other national brands too, and there's probably a cadre of probably a dozen to 15 brokers that I work with very regularly that understand what I'm looking for, are good advocates for me to their sellers, because they know I'm very focused on alignment and transparency. And frankly, I just do what I say I'm going to do, which is, again, a simple
Really great.
concept, but one that is super,
Yeah.
super hard to come by in our sector, right?
Yeah.
Um, I fully embrace the brokerage community. We've done a ton of great deals on that side. We obviously as well try to direct source deals where we can. I find that in most situations, because we're buying assets that are generally $10 million and up, these owners will want to run a process through a brokerage, even if it's not on the market yet, which makes sense. I would do the same thing. But we try that as well, at least to get in front of people, whether they're owner users and they're considering sale leasebacks, or they are large institutions. Because I think having that name awareness, that brand awareness, helps when it comes time to select a party to meet you and complete the transaction. And then we try to use as much of our network beyond our brokers as well, and that includes our attorneys, our tax advisors. Obviously, a lot of similar companies to ours use a lot of the same type of vendors, and so we try to maximize those networks as well. Our title folks have been great on that front, and it's really just a collective effort across every type of vertical we can to make sure we're seeing everything in the market. And that's probably why I get 350 emails a day about the next deal.
Sorry for the amount that we contribute to that, but what can you do? Sorry, not sorry, right?
I'd rather know than not know.
Yeah, exactly. Fair. You had mentioned that you work with, I believe, private accredited investors. Talk to me about what your structure looks like if you were an investor who wanted to come in and take a look at your fund, and how are you financing your deals overall?
Yeah, great question. I love to talk about capital markets. So when we did our first 20 acquisitions, we syndicated each one of them. So they were all standalone deals. We would go raise the equity, and we would get debt from regional banks and credit unions mostly. This was before interest rates went up, and a little bit of CMBS and Lifeco action. Now, as the market has changed, we launched Sentinel Opportunity Fund 1 about 3 months ago. It's a $100 million fund, and we've raised about $42 million so far. And it's, to your point, all high net worth individuals, family offices. We don't take institutional money. We feel very confident in our strategy, in our thesis, and so we really want to have the decision-making capabilities across the board here and not have to rescind that to a larger investor. What's cool about the fund, and I've learned this after having, we have about 400 different investors on our platform. We've gone round trip on a few deals, including one that we actually acquired through CBRE not too long ago, and it was an absolute home run for the investors. We generated a 1.9 equity multiple in less than 24 months on an office deal in the Midwest.
Wow.
And the thing I heard from a lot of our investors that didn't get into the deal is, how come you didn't tell me to get into this deal? And so one thing I realized was, all of my investors tell me they want to have the ability to pick and choose, but yet they're not quite dialed into what is a good deal and what isn't a good deal. I think we should start a fund, because I have this very thematic approach to the way we're investing now, right? We're buying at these ultra high cap rates. Debt is more expensive, but I'm getting longer term. So most of what I'm buying is like contractually a full return of capital, if not better. So it checks off a lot of those boxes, and it's a way for, I think, our investors to participate in our strategy holistically. And is every deal going to be a 1.9 in 2 years? Of course not. That's insane. That wasn't even our projection. but it allows you to participate in the singles and the doubles and the home runs collectively. And if you're a believer in our strategy, it's the best way to participate with us. And so it's open to new investors now. Anyone can visit sentinelopfund.com and download our investment summary to learn more. And as it relates to the financing, we are doing more and more CMBS debt right now because we are finding that to be really the easiest way to get an office deal done in this market. We're still going out to about 120 lenders on every deal, but CMBS is the path of least resistance, giving me 5 years of IO on a 5-year term versus a 5-year deal that maybe is on a 25-year amortization schedule. Really impacts the cash on cash. And a big part of what I do is I want to return that capital back to the investors as quick as possible.
And what is your standard hold time? Sounds like you've had some that you turned around pretty quickly, but what's your projection? And I'm sure that's especially important if you're putting debt like CMBS on it, which is a little more rigid. So how are you modeling that out?
So we definitely we are not assuming that we're going to sell any of these deals within the fund that we're acquiring now in the next 5 years. Obviously, we have yield maintenance on CMBS deals
Right.
if we were to do that. So that's not the plan. In my heart of hearts, I do think in that 5 to 6 year period of time, I think we're going to have a great opportunity here because a lot of our deals are still going to have a substantial amount of lease term. Like the first the first property we acquired in the fund is a 20-year sale leaseback. So, and we bought it at a 10 cap. So
Nice.
I feel pretty good that in, 6 years with 14 years of term, if interest rates are inside where they were where I bought them, I probably can get a little bit of cap rate compression and make a nice pop on that. The fund itself can be over a decade long if we utilized all our extensions. But really what I'm trying to do here is make a trade based on the general conventional wisdom that's anti-office coupled with this high interest rate environment that has expanded cap rates. So I can clip a coupon that is essentially double or triple what you're going to find in the multifamily sector, usually double what you'll find in the industrial sector, and still stronger than retail. And yet I'm still going to be able to participate in this event if it happens when interest rates compress substantially at some point in the next decade.
It sounds like you have every angle covered, or at least that's the hope, right? You can hold it, you can sell out of it, you can, refi, whatever it might be. It sounds like you've got all the different scenarios. So I hope it works out exactly like you said. And a 10 cap with a 20-year sale leaseback with a solid tenant sounds like a pretty good start to me without knowing much else about the deal. So sounds like you're doing well on the buy as well.
Thank you.
You've been through some, I think, the most fascinating time. We'll look back and say in the market in my career, which has been a long time, in the last 4 years. So you started this company right before the pandemic, you mentioned. Of course, we had just insane cap rate compression and a frenzied market after we came out of the first year of the pandemic. Then everything started dropping with interest rates spiking. I mean, we all know the story here. It's been wild. So I feel like if you've weathered these swings with a company, you're definitely ready for whatever comes next. That said, if we know one thing, it's not to expect that we know what's coming next. So what are you most worried about, or what are you watching closely for the next 2 years?
Yeah, that's I love that because as smart as I think we are at my company, we wholeheartedly agree that we don't know what comes next, and that's why we buy properties that we think make sense in this environment, even if it was to stay static for the next decade. The next 2 years, a couple things concern me. Number one is I would say there's a lot of dry powder out there, and I've already seen some deals where I think some of the largest investors out there are a little trigger happy on just deploying that capital because they don't want to give it back to the investors. I know you would think there's an altruistic version of a trillion-dollar hedge fund or multi-billion-dollar hedge fund where they just give back the money if they don't see anything they love. but more often than not, they just make bad decisions.
Yeah.
And so I'm a little nervous about if we're in this elevated interest environment for much longer. If you look at some of the other asset classes, in particular, single family, multifamily, and the core industrial, you're seeing a lot of deals done with negative leverage. And that was literally investing 101 for me that I learned was, don't take equity risk when debt is 150 basis points higher. It's a whole different deal if you're doing something on a value add or a construction basis, but to buy a stabilized asset with negative leverage, it just seems insane to me. And I'm very nervous about A, if more people do it, and B, what the fallout of what's already been done occurs.
Are you worried more from the lender perspective that we might have defaults that kind of dries up, lending ability in the market broadly? Or are you worried about the effect to price compression if people are making higher risk, in your mind, trades, or both?
I'm definitely worried about the price compression and cap rate compression when it doesn't need to exist. I do think we have to take our medicine when it comes to a price correction in commercial real estate. So for people to buoy those values up just because they're sitting on dry powder, I think that's a bad thing for the industry. I think that's not great optically, especially if those deals don't end up performing the way these folks predict. You have to have some serious financial gymnastics that have to occur. You got to stick the landing like Simone Biles in some of those pro formas to have a chance of even getting to a double-digit IRR. So that makes me nervous because if I'm an investor who only has 300 plus million, there is trickle down optics that affect me when the big guys make mistakes.
Makes sense. No, I think that's fair. We have to end on a positive note, though. So tell me what
Yes.
you are most excited about for the next 2 years, or you can take it a different direction and tell me a type of deal that you're watching, haven't invested in yet, but are excited to perhaps buy your first XYZ type of asset, or both questions. Go for it.
Sure. Well, look, I'm very excited about the opportunity in office because luckily I've been right on my career on a few other things before the rest of the market jumped on it. One was single family lending. I was one of the first folks in that space, the single family rental lending, and then the build for rent sector. I was one of the first operators in that space. Luckily, I had Carlyle Group as my equity partner, scaled it brilliantly, and then sold it at the right time. I think I've got a very similar runway with the office sector right now. So the next 2 years, we are going to pick up as much of this stuff as we can, as long as we think it makes sense. But to me, it's kind of a no-brainer if you can buy a stabilized Class A office building at $150 a foot when it costs $500 a square foot to rebuild. That's a no-brainer to me. Super excited about it. I have no problem if everybody else hates it. That served me well in the past. And I'm looking forward to how I can take advantage of it the next couple of years.
Anything not office related that you're kind of skirting around or dipping your toe in? It could be
Yes.
data centers, hotels, medical.
It is data centers.
So many other. It's data centers. I got on the first guess. No way.
It is.
All right,
It is.
tell me about data centers.
It is data centers, but it's not buying data centers. I am really more focused on the entitlement of data centers because, and I've researched this industry for the last 8 months because I've been fascinated by a lot of the headline news that I read, and much like I do with Office or BFR or anything else, I have to read 8 billion different things to form an opinion on it. And what I've realized about data centers are they're very needed. They're undersupplied. They're ridiculously expensive to build. And they're not even easy to develop or entitle. And so because I have a background in entitlement and land development, that piques my interest. I don't want to go try to build a data center at $1,800 a square foot.
Yeah.
That's not the game I want to play in. But if I can go selectively acquire some data center, some land options to potentially entitle data centers and help provide that next supply for the developers and end users, the hyperscalers, I think there's a tremendous opportunity there. And we're not there yet, but we're definitely exploring it, and it seems like there's a good runway there as well.
We'll check back in a year. I agree that that is going to absolutely explode. It's not something that our team focuses on either yet, but I do think it's just fascinating, the growth that we're expecting to see. So good luck with that new venture. And of course, good luck with all of your contrarian office views, which seem to be paying off. Any concluding thoughts on the market or the company that you'd like to share?
I'm just thank you for having me on today. I really appreciate the conversation. I've been a big fan of all the content you put out there, and I think that an important part of our industry in general is just having conversations like this, staying educated. I think those folks that stick to their guns and an old opinion of things are going to be relics. You have to adapt. You have to evolve. And luckily, technology is helping us bridge that gap and become more intelligent investors. So, I encourage all your listeners to continue pushing forward and dig a little deeper if something doesn't look right to you, if the conventional wisdom doesn't quite vibe with the way you see things.
Couldn't agree more. Dennis, we're so happy you were able to come on the show today. Really appreciate all of your thoughts and insights. And thank you for sharing everything today and being a part of CRE Fast 5.
Thanks so much, Karly.
To everyone listening, that was CRE Fast 5 Secret Sauce. Thanks again for tuning in, and we will see you again very soon. Take care, everyone.